Many Canadians use financial advisors, some use robo-advisors, and some prefer to index invest on their own. However, there might be an easier way to outperform them all. Joining me now is Ed Rempel, a fee-for-service financial planner and tax accountant with How That's Possible. Ed, thank you for joining me at the Canadian Financial Summit this year.
Great to be here, Barry.
Ed, I know outperforming index funds is no easy task, but you say a lot of investors and sometimes advisors make a lot of mistakes. So how is this possible? How can people outperform index funds?
Yeah, so if what I'm talking about is outperforming index investors, and I find I've seen lots of portfolios, and the portfolios that index investors make, they tend to make the same mistakes as financial advisors and robo-advisors. And there's four categories of them. I call them the four performance drags, and and most people do these in a portfolio. That's what really drags down your performance. I even have a measure of how to be able to tell how much it's dragging it down. And then I'm going to be talking a little bit about how to outperform. There's a few secrets you can do, and it's how to outperform, and you can even use it to outperform index funds.
Okay, I'm really looking forward to this presentation, Ed, so take it away.
How to easily outperform financial advisors, robo-advisors, and index investors. So, financial freedom and financial security, why don't most Canadians get there? So why don't they become financially independent, when they want based on their financial plan? Why don't they retire with their desired retirement? And, from what I've seen from experience, the biggest reason is most of them have suboptimal investments or they're focusing on the wrong risk. Okay, we're going to talk today about why is good performance important for your life? What rate of return do you need to become financially independent? What are the four performance drags that reduce investment returns? What is the asset allocation loss ratio, the AALR? Why is it easy to outperform financial advisors? And what is wrong with the investment industry definition of risk? Why is it easy to outperform robo-advisors? Why is it easy to outperform index investors? How can you learn to think properly about investing? And what are the secrets to outperforming? So first of all, we're just going to talk about why good performance is important. And this, from experience, we've written, well over 1,000 financial plans. And the bottom line is, unless you have a high equity rate portfolio, it's very hard to make a retirement plan work and to actually get there. And I get some simple examples. So here's a couple. This is a modest retirement. Say it's a couple making 50,000 each, 100 together. They want to retire on 40,000 each. That's 80,000 a year. They're 35 who retire and they're going to save for 30 years and retire at 65. With 3% inflation, and they get all the government benefits. So now when you look at it, if they have a balanced portfolio, let's say long-term making 5% a year, they need to invest $34,000 a year. That's 34% of your income. Now you think of it, if you picture yourself, you're a couple making 50,000 each, it's 100,000 total. That's before tax, and you need to invest 34,000. That's ridiculous. Basically nobody can do that. Now, if you're getting an 8% rate of return, like an equity portfolio, then you need to invest 13,000 a year. That's 13%. That's not even maxing your RSP, and you get there. So, with 8%, it's not easy, but it's certainly doable. With a balanced portfolio, it's basically impossible. You have to invest 21,000 a year more. If you invest more conservatively and have less ups and downs in your investments, you have to invest 21,000 a year more to make up for that. That's ridiculous. So, here's a more modest one. So a couple are 100,000 each. So that's 200,000 together. They want to retire on 150,000. Everything else is the same. So here they have to invest 100,000 a year. No. So if you're making 100,000, then you're paying a lot of tax. So you're making 200,000 total. They have to invest 100,000. So that's half their income. Again, ridiculous. So, but that's with a 5% return of a balanced portfolio. But if they're an 8% return equity portfolio, it's 40,000 a year, 20% of their income. RSP plus a little bit. So again, doable. For an upscale plan, let's say you make 500,000 a year, you want to retire on 300,000 a year. So a comfortable retirement. Now you have to invest 265,000 a year. That's 53% of your income. It's more than half. So again, that's with a balanced portfolio. With an equity portfolio, 21% of your income. So, RSP plus a little bit. So bottom line is, this is why, it's the risk of a fear-based mindset is that if you have a balanced portfolio with a long-term return of 5% a year, it's basically impossible to retire comfortably for pretty well all the financial plans that we've seen. So you generally need to invest between 35 and 50% of your gross income, which is, before tax income. That's ridiculous. But with an equity portfolio, say 8% a year, long-term return, it's like 13 to 20% of your before tax income. It's not easy, but certainly doable. So this is why it's important to invest and get a good rate of return. So now why you need a growth mindset? So bottom line is you cannot retire comfortably on a 5% per year return of a balanced portfolio. Comfortable retirement requires a 7 or 8% per year returns of an equity portfolio. And, I've done, well over 1,000 financial plans, and this is just what I've seen. You change it down to 5% a year, you can't really do it. And that's, bottom line is when we're doing financial plans, we're using 3% as the inflation rate. And that's, kind of the high end of where the Bank of Canada is trying to keep it. And actual inflation since 1950 has averaged over 4, but they're trying to keep it below 3. So we're using 3. And then so if you're making 5, you're only a little bit ahead. But if you're making 8, you're quite a ways ahead. And that's the difference. So another really important thing is even after you retire, so if you're retired for 30 years, between 70 and 90% of your retirement income is based on growth after you retire. So it's not just that you have a big portfolio when you retire, age 65. You need growth after you retire. You need to continue it. So this leads to what I call the nightmare, the really nightmare on Elm Street, terrible thing. So the nightmare is, the typical financial advisor meeting. It's just a real nightmare. So you go and see a financial advisor. They don't do a financial plan. They whip out a risk tolerance questionnaire. You come out moderate. You get a balanced portfolio, and you're already screwed. Basically, you cannot retire comfortably. And the thing is, you don't have a retirement plan, and you don't even know it, and neither does your advisor. So that's why I think of that as that's just like the ultimate nightmare scenario. So now let's talk about the 4 performance drags, the 4 main areas that we see people, that drag down their performance. So, and you can easily outperform financial advisors, robo-advisors, and index advisors or investors because they tend to use these 4 performance drags. So the first one is fixed income or bonds. And often, I call it forced bond investing, FBI. It's like the FBI is after you, but it's often they're, forcing you to do it. Then there's home country bias. There is riding the brake, which is just a variety of ways of investing more conservatively. And then there's, one idea investing. You shrink your universe down to just one idea. Even if it's a good idea, it's usually not effective. So, and bottom line, it's short-term thinking versus long-term return investing. That's the difference. The performance drags are all about short-term thinking and, instead of focusing on the long-term. So what you need to do is invest for what I call maximum reliable long-term total returns. So don't worry about ups and downs of the market. Get investments that are reliable long-term, which basically the most reliable long-term have been equities. So that's why I like to show this tombstone of Elijah Bond. It's basically I declared the death of risk of bonds to your retirement. Or basically it's, I think you need to understand that bonds are a big risk to your retirement. It's because the rate of return is so low. And, I kind of funny that he's created the Ouija board. It's kind of like we had you believing this for a while, but, it's not true anymore. So what I want you to understand the concept of short-term versus long-term risk, because people tend to think of risk as, my money investment's going down or, the fluctuations of your investment. But, that's the short-term risk. With equities, you tend to get that with stocks. Equities and stocks are kind of the same thing. But, you get lots of ups and downs, and so those are all short-term risk. But it pretty well always works itself out with, over a few years. The big risk that affects your life is long-term risk. If your bonds and cash, and much of the time they don't even keep up with inflation. So you don't see any significant fluctuations, but they're not even keeping up with the money. They're not even keeping your purchasing power even. So your currency maybe rise, your dollar invested may be rising slowly, but what it buys, the actual money, is declining. And that's a loss over the long term if you're not keeping up with inflation. So what is asset allocation loss ratio? This is AALR. It's something I created myself. And basically it's just a concept. It's a way to kind of do a trade-off between growth and lower volatility. And it's because it's something you need to understand. So we think of equities as the core of long-term investing. So I think most investors should be high equity or 100% equity portfolio. And that's, equities have been the most reliable over the very long term. And, they give you a good rate of return. Now, if you're going to choose a more conservative portfolio, you should expect a lower rate of return. And basically, AALR it's a way to estimate how much difference does it make. So I'm choosing a more conservative portfolio to get lower volatility, but I'm going to get less growth. How much lower growth do I think it's going to be? And then how does it affect your plan? It's just, it's something that it's an important trade-off to be able to understand when you're deciding what makes most sense for you. So you get smaller ups and downs, but lower long-term return. So, and you should put that lower return into a financial plan, and you see how it affects you. With ones that I showed you early on, it's something shocking at how much it affects your plan. I invest a bit more conservatively, and basically I can't retire comfortably at all. Or, I get no travel or entertainment money when I retire. It's like, so when you see what it does for you in your life, it can be huge. And that's what AALR is, just a way to try to measure, how much you're losing from a suboptimal asset allocation. So the general example is that for every 10% in bonds, you lose about 0.4, it could be a bit more, say 0.4, 0.5% per year rate of return on your investments over the long term. So for every 10% in bonds. And let's say, so 25% in bonds, you're losing 1% a year over your life. And it's kind of a way of thinking how that would be. This is obviously an estimate, but if you can use it as a way to try to see how much you're kind of losing based on this. So that's AALR is from putting fixed income, bonds or fixed income in your asset allocation, and now you should expect a lower rate of return, and we're able to kind of measure it. So number 2 is home country bias. And, in every country of the world, they think investing in their own country is safer. And somehow, you're buying companies that in your own company, you think they're safer. But, home country bias is dumb in every country of the world, except possibly the US, where most of the growth is. But, the rest of the world, it really is. And it's funny, about over 10 years ago, Iceland had a major market crash. And I found out that, 80% of the amounts invested by Iceland investors were in Iceland companies. So, the funny thing about it is, my first thought was, Iceland has companies, like I can't think of any, but Iceland, the companies in there are basically like Canada. It's mostly financials and resource company. It's a lot like us, but it had a huge crash. But again, they were mostly just invested in their own company. So to show you the difference, how much you're losing. So last 15 years, Canada's index TSX 60 averaged 8.4% a year. 1,000 would have grown to 3,350. In the U.S., the S&P 500 has averaged 16.2% a year last 15 years. It's significantly above its long-term average. But 1,000 would have grown to 9,500. Globally, MSCI World Index has averaged 13% a year, also a bit higher than average. But 1,000 would go to 6,250. So you've gone 1,000 to 3,300 Canada. Globally, 1,000 to 6,200, US, 1,000 to 9,500. So it's a lot that you're losing by having your money in your own country. And, Canada is, a slower growth country. Most of the growth in the world is outside of Canada. So, it makes sense to have, maybe a bit in Canada, but very little. Canada's stock market is only 3% of the world's stock market. So if you're looking at market neutral, it's not, 25% Canada, it's 3% Canada. And then, we generally believe in you should just invest globally. And then when you do that, you best buy the best companies in the world. You might end up with a bit in Canada, you might not. It's wherever Canada is the biggest. But, in Canada, it's like 75% of our stock market is only 3 sectors. We call it rocks, trees, and banks, but it's basically resources, energy, and financials. And, when you go to the MSCI World Index, what you see, it's far more diversified. All 14 sectors have significant allocation. The companies are quite a bit larger. In fact, you might be surprised to know that the average company in our index, Canada, TSX 60, the average company is smaller than the average country in the emerging market index. So we're not large companies. We're not high growth. We're not diversified in Canada. So it's better to have your investments, globally or in the US. Number 3, riding the brake. I call it riding the brake, but basically there's a variety of ways of just investing more conservatively. It's not just that asset allocation. There's other things you can do. So it's basically, I call riding the brake any method to reduce short-term volatility, but basically anything you do probably also reduces your long-term risk. So it's focusing on short-term risk and a short-term thinking. So short-term thinking is the risk because it gets you focused on the short-term risk instead of, getting the maximum reliable long-term rate of return. So when you're thinking this, conservatively, you end up with suboptimal investments. And there's a bunch of methods. So some of them are, balanced asset allocation or target date funds, that kind of thing. There's incoming investing. There's GICs, bonds, income funds, all kinds of things that produce income. There's some, trendy things like low volatility and smart beta. And then, sometimes there's even stocks, but just conservative stocks like infrastructure or dividends or real estate or something people think their home country bias. Home country is the conservative. But when you're focusing on, more conservative, you usually, end up with pretty well anything that reduces volatility probably also reduces your long-term rate of return. And the fourth one is what I call one idea investments. It's like, honey, I shrunk the universe. So basically, you're reducing your university of stocks to one sector or one style of investing. And there are a variety of ways to invest effectively, but you don't find all the best companies within any one method. So the most common one I see here is dividend stocks. And a lot of Canadian stocks are dividend stocks, and even a lot of the US ones are dividend stocks. You can't avoid dividends. However, just looking for dividends is, leads you astray. And I did a few videos about this, dividend investing is a brain fart. And it really is. There's no difference between a dividend and selling your investment. I think it's a slight tax difference, but it's the same concept. Both ways, money is coming out of your portfolio. And if you doubt me, watch the other video, you'll see it more clearly. So the dividend itself is meaningless. Okay. Now, dividend investing can be a decent way to select good companies. So there's a fair number of good companies because at least you don't get money losers that way, or you don't usually do it. However, just by looking for dividend, you don't necessarily get all the good stocks. So you're just focusing the world only on that. So we've seen lots of different versions of this one idea investing. Back 25 years ago, we had the tech boom in the 90s, and everybody that I knew living in Brampton, everybody we knew had Nortel. And then there's trendy, again, ideas like low volatility, smart beta. People are just all into this. So, low volatility, get a good rate of return, even though volatility is low. And then for a few years ago, we saw people all over pot stocks, and more recently it's crypto. But you're shrinking your investment down to one idea, and it's very unlikely these kind of things are going to work long time. And you got to think, is it reliable long term? Like even crypto's done really well, but is it reliable long term? And the problem is, nobody knows. I don't even know how to write a financial plan with crypto, because what rate of return is it going to make in the next 25 years? I have no idea. Could be minus 100. It could keep growing at 20 or 30% a year. I don't know. How do you make a rate of plan with it? So the question, is it reliable long term? So let's look at some of these. So why is it easy to outperform financial advisors? Now, I'm going to make some comments here that are generally true. It's not true of all advisors. There are going to be exceptions to this, but just from experience, this is the kind of thing that I see generally. And it's also when I talk about index investors, robo-advisors, it's just what I generally see, the most common ways. So basically, financial advisors, most of them tend to use these for performance drags. Especially, they use a fair amount of bonds, home country bias, and some of the riding the brake of various conservative strategies. So, and basically, what I find often is people, the negative about financial advisors is you're paying a fee or you're getting good advice. But often, I find the performance drags are bigger than the fees that they charge. It's often quite big what you get from that. They also tend to have, what I consider to be bad market timing. And what you see with most advisors, and when I talk to some financial advisors, they'll say that I get a review with a client and I have to change something. So they think that I'm doing something. So whatever they're doing, I take all their investments, I take whichever one did the worst, sell it and buy more of the one that does the best. So things look good. And that's just, this is the opposite of what you should do, right? But it's just, trying to make a change it's just bad market timing. Financial advisors tend to focus on the short-term risks. And, and they're not focusing on your retirement goal because very few of them do a retirement plan. So they're just, they're not focused on what rate of return do I have to get to retire comfortably. They're focused on, the market is doing this. You want to protect yourself from the market. And a big part of it is that they've got compliance departments that are really strong. And that often leads to what I call the forced bond investing, the FBI, call the compliance department the FBI. But often it's, based on your risk tolerance of the client, you have to invest more conservatively, which means you have to have a bunch of fixed income in there. And which is going to be a problem for your financial plan. And financial advisors also have marketing reasons. They don't want to lose a client, and often they think if I have a big down year, I'm going to lose a client, so I'll just invest more conservatively. But again, they're not looking at your long term. It's better to spend some more time educating you about your financial plan and what do you need to do to retire comfortably, and what does risk look like, and if they help you with that, could be much more effective. So financial advisors all do a risk tolerance questionnaire. It's required so that you don't invest too aggressively, but hardly any of them do financial planning. And financial planning can be useful because it puts the long-term perspective on it. And then when you have a financial plan and realize, man, I need to make 8% a year to retire comfortably, well, then you start thinking different about your investments. Well, okay, how do I get this reliably? And you think very differently than you think, risk tolerance, just invest and reduce, reasonable risk with less returns, but then you're going to underperform. So, effective investing would be the maximum reliable long-term returns. Now, why is it easy to outperform robo-advisors? Again, there's general comments, and, but they basically tend to use this forced bond investing, FBI. You always have some bonds in the portfolio, and, some home country bias and riding the brake as well. So, and just to give you an example of what it's like, an engineer called me up, late 20s, knowledgeable about investing, a very aggressive investor. He's looking for 100% equities, switches over to a robo-advisor. And he told, the way he explained it, he says, I gained the risk tolerance questionnaire. I just picked the highest risk in every single answer. And it came out that he should be in 20% bonds. He says, why isn't 20% bonds? So he phoned in and talked to the portfolio manager for the robo-advisor. And basically they said, the least we can do is 10% bonds. You have to have bonds in there. And then he called me up and he says, why are they forcing me to have bonds? And it's, I know. And then the honest answer is it protects them, that they feel that they weren't too aggressive. And they're robo-advisors, they don't necessarily know you that well. That's not necessarily in your best interest. So, the most aggressive people should be 100% equities and can tolerate it. And so if you can tolerate it, then, you should be able to get that. Another really interesting thing is, back in mid-2017, I saw a bunch of bloggers, blogging back and forth, and someone was blogging that they had money with a robo-advisor, and they were 10% below the index for the first 6 months of 2017. Now I looked at what they actually posted what they had on there, and their robo-advisor just had, the main broad indexes, S&P 500 and MSCI World Index, and thinking, how could they be 10% below the index in 6 months with that portfolio? So went back 6 months to see, okay, what do they have 6 months earlier? And, end of 2016, what they had is a bunch of these trendy things like low volatility ETFs and smart beta ETFs. And that was right after the Trump election. After the Trump election in 2016, the market took off, changed to more growth. We had a strong year in the markets, but they had all this trendy stuff that was, lower volatility. And that's why they were 10% off. And they quickly switched back to the broad indexes. But it's, it's things that they look good from a marketing point of view. These smart beta ETFs. So it looks good from a marketing point of view. They have this clever stuff in here. But, it ends up underperforming by a lot. So you'd think they just, have a broad index, but that's not often what they do. So why is it easy to outperform index investors? Now, when you think index investors, you'd think they would just have one index, right? They would just have the MSCI World All Cap Index or the S&P 500 or the MSCI World Index. Just one broad index. If you're an index investor, just have the index and that's it. But the thing is, when I look at index investors, somehow they rarely have that. And it's a weird thought. It's kind of a thought that I shouldn't have everything in one basket. I should diversify. And it's actually backwards thinking because, if you have the MSCI World All Cap Index, that's the broadest diversification. You have everything. If you buy the other indexes tend to be much more narrow. And by, having more narrow ones, you're actually less diversified. So, it's funny to have one investment is the most diversified and have 3 or 4 is less diversified. That's weird thinking. So what I find with most index investors, they tend to use bonds and they tend to have home country bias. Often you get these asset allocation ETFs that index investors like to have. And, typically you see something like 25% bonds, 25% Canada, 25% US, 25% international. Looks diversified, right? Oh, they're all index funds and they're all low fee and it's diversified. But when first of all, you think 25% bonds, remember the AALR. So there you're losing probably 1% a year of your long-term rate of return right there, possibly more. And then they're dramatically overweight Canada, which has got a low long-term return, right? So the index weight of Canada is 3%, but they're at 25%. Then they're underweight the U.S., which is the highest growth Canada. U.S. is actually about 60% of the world market is U.S., and they're at 25. So they're dramatically underweight U.S., dramatically overweight Canada, 25% in bonds. So it's actually not, it's very easy to outperform that. So you'd think again that they'd buy one broad index. And when I've talked to index investors, that's what I tell them, like, pick one index. And, if you have 3 or more, it's probably worse. So you're probably, less diversified by focusing on specific things. And, a general comment on index investors, the focus is so often on fees, but often the AALR from their portfolio is larger than the fee savings. So they'd be able to pay an advisor if they could avoid the AALR from their investments. So how can you learn to think properly about investing? And, the big thing here is what I call maximum reliable long-term total return. So we're looking for reliable long-term, not reliable short-term. And, equities are that. If you look at the long-term trends over 150 years, you see that the returns they're on the 100 or the 200-year trend line from 1800 has been very, very steady. That you tend to get a very steady growth is, inflation plus 7 has been the long-term return. And equities have been quite reliable long-term. In fact, they're more consistent over 20 plus years of times after inflation than bonds. So you need to have a higher risk tolerance to do this, but it's a learned skill. You can learn to do it. How do you learn to have the skill? But the big thing is just to understand the market. I find a lot of people have a lower risk tolerance because they have a low understanding of the market, and they tend to think it's much riskier than it actually is. So study what it actually is. Like, how often are there declines? How big are they? How long does it take to recover? Like, get an accurate sense of what the risk return of the stocks are versus bonds and cash. You get an accurate picture of it. So, and then, so a proper equity portfolio has been reliable long-term. For example, I've got the calendar year here since 1871. So the worst 25-year return of the S&P 500 in the modern stock market, say since 1930, when it was no longer farming and railroad stocks. So the worst 25-year period was a gain of 8% a year. Now that's the worst one. This is calendar year returns, but 8% a year is not bad at all. That's what's often is that's why we often use 8% in a plan. We kind of think of, well, if we have a really bad 25 years, we should probably still be able to get 8. And so it's the worst case isn't you go to 0. That's decline market crashes aren't to 0. They're just 20 or 30 or 40% or something. Sometimes 50, but then they usually bounce back fairly quickly. So, and there's going to be some turbulence, but I call it turbulence tolerance. Tolerance. It's again short-term versus long-term risk. And when you're in a plane, you get some turbulence. The dumbest thing you can do is jump out. Same thing with stocks. You get some turbulence. Worst thing you can do is jump out. When you're flying, you know that there's going to be some turbulence now and then, but you know what? Flying is still the safest and fastest way to get to where you want to go. And stocks are the same way. Just stick with it and just ride it out and you'll get there. You need to have that confidence in your investment. And a big thing is exactly that. Own something that you're confident in. So if you're an index person, get a broad index that you're confident in, have that. Like we tend to use these, what we call the all-stars. Like we have portfolio managers find the world's best investors for us. And, that's because you've got these really smart investors that are making decisions for you. So that's what gives us confidence long-term. But you need something that you're confident in so that you just stay invested, when things are going down. And so risk tolerance, it's a learned skill, and it's really nothing more than the ability to do nothing when your investments go down. Now, you think doing nothing is easy, but sometimes it's not. You're just so tempted to do something when your investments are down, but just do nothing and ride it out. If you're confident in your investments, you can do that. So now what I call investment risk that affects your life. So it's not just ups and downs in the market. The real investment risk is the risk of not achieving the life that you want. So if your financial plan says you need to earn 8% a year rate of return to have the retirement you want, then the risk is the risk of a 30-year return below 8% per year. That's the definition of risk. So the market falls by 40%. That's not risk because it'll, if it comes back over a couple of years and you still get 8% over 25 or 30 years, then it wasn't risky. But however, if you have a bunch of bonds and you make 5% a year instead of 8%, that's risk. So it's this lifetime risk. I call it financial plan risk or investment risk that affects your life. Just think of it that way. It's the real risk of investing is the risk of getting a rate of return that's lower than your financial plan. That's what really affects your life and your ability to live the life that you want long term. And to do that, you need to be growth focused and have an optimistic view of your life and the world. But you can do that. So long term risk is the right risk to think about. All right, and I have charts here just showing this is the 200-year chart return of the stock market. And this is, notice how close it is to the trend line all the time. It's 6.8, like 7% real after inflation. But bonds you see are much more. They have 40-year periods where they go lose money after inflation, or where they do quite well, but they're much less consistent than the stock market is. And if you look at standard deviation, which is the measure of risk or uncertainty of investments, again, 200-year study, stocks compared to bonds and cash, stocks are more risky and less predictable for over 1, 2, and 5 years, even a bit over 10 years. But when you're 20 years and 30 years, stocks are actually more predictable after inflation than bonds or cash. So they are the reliable investment, and the returns are much higher than bonds long term, like much higher over the long term, and they're also more predictable. So that's why stocks are kind of the core for a long-term portfolio. You look at the 1 year return of stocks, and it's all over the map, up and down, up and down. But when you're in for 25 years, you see how consistent it is. And in fact, the modern stock market, which is like from 1930, so 25-year period ending the early mid-50s, you'll see the worst 25-year period has been 8% a year, which is a pretty good long-term rate of return. So stock market predictions, here's the view. I don't know what will happen this year, but I do know, based on history, that 25 years from now, the stock market will be between 7 and 17 times higher than today. So when you're investing, think about that. The market's going to be 7 to 17 times higher. Let's just get all of what the market does. So, and that's the right way to think over the long term. So what are the secrets of outperforming? Actually, I just want to hear the secrets of outperforming. 7 of them. One is invest 100% in global or U.S. equities, so you have no AALR. Get all the return to the bull market. So don't try to forecast to find people when the market's going up, they're thinking, at what point should I get more conservative? Because I think I'm trying to time it all the way down. Don't even do that. Just ride it all the way up. Get all of the growth when it's going up. When it goes on sale, then just always try to buy more if you can. And you know what? You want a simple way to beat the index is stay invested 100% of the time, and whenever it's down 20% or more, just buy some extra. That's all you need to do when you're going to beat the index. So avoid those 4 performance drags. They really drag things down for you. Be confident in your long-term growth, which means owning something you're confident in. Another thing you can do is you can get index investing, but also you can do above index investing. And that's why we're using these portfolio managers that are investing, that are finding the world's best fund managers, all that have long-term performance of beating the index after fees. So it's a portfolio manager that has a method. They're trying to find these all-stars. They're trying to actually outperform the index. to, at least pay our fees, but hopefully more. And then the other big way to outperform is leverage. So if you've got solid investments that you stick with long term, and you can borrow to invest, interest is all tax deductible. And so over time, your rate of return, if your investments are tax efficient, your return after tax on the investments over the time should be quite a bit more than the interest after tax that you borrow and getting other people's money. It's, like the most effective method to grow wealth long term. So thanks for listening. My name is Ed Rempel. My blog is Unconventional Wisdom. It's the #1 blog in Canada for a full-service financial planner. It's just edrempel.com or unconventionalwisdom.ca because we're in Canada.ca. If you're interested in potentially talking to us about whether or not we're a good fit to work together, we offer a free 30-minute consultation. It's just edrempel.com/talk. Also have a podcast on YouTube. Podcast is edrempel.com/listen. YouTube is edrempel.com/watch. Thank you for listening.
And this was a really fascinating presentation. Even as an index investor myself, I'll admit I've made some of these mistakes. So I'm glad you pointed it out. Ed, thanks for joining me at the Canadian Financial Summit this year.
Great to be here, Barry. Thanks for inviting me.